The year 2022 has been a year of peak and turfs and twists and turns. Looking at the market volatility, the macro environment, the news on war, first challenged the bulls, and now the market setup is asking a big question to the bears that the bull market is not over. So is the bull market genuinely not over? And if the bull market is not over, how should one still participate in this bull market? Now to answer that, to analyze that, to dissect that, and to talk about where India is headed and what returns we should expect from market in the medium to long term, I've got the perfect guest, someone I've interacted with over the years on different forums. We've debated and argued about the India story, but we've always shared one commonality, that never ever give up on India. We're celebrating 75 years of independence. We can argue about this should have been done, this has been done, and this needs to be done. But the bottom line is, India today is standing tall, top of the pedestal nation.
Yeah, that's true actually, Nikunj. And in fact, what we've achieved in the last 5 years on many other things, because we are hugely focused on stock markets, right? But look at the number of tertiary education institutions that have come up in India in the last 5-7 years. We've doubled the count. So what we did in the first 70, we've actually managed to do in the last 5. And this is what is happening to India. India is doubling at that rate. I mean, a lot of things in India will double in the next 5-7 years. It takes 70 years to get to a certain point, and then suddenly you acquire a momentum, you acquire a level which then you go to the next level. And that is why we are in the midst of this bull market, because the market is damn smart. It sees this coming. It senses that this is a breakout time for India. And there are a lot of things outside India that are cooperating with us. So for example, Morgan Stanley has this multipolar world thesis, which is we are moving away from a bipolar world which was dominated by China as a production house and US as a consumption house, to a more diversified world where there will be more centers of production and there will be more centers of consumption. Guess what? India is one of the very few in that lot which is both. Yes. The center of consumption, and it is going to be a center of production. So one of the longer term calls that Morgan Stanley is making is that manufacturing will come back. In the last 25 years, ever since we opened up our country, dismantled the industrial Raj, ironically manufacturing declined as a share of GDP. We think that's changing in the next 10 years. We're seeing huge tick up in FDI coming. We run a proprietary MNC sentiment indicator, which basically serves through 3,000 reports of multinational companies. It's done with artificial intelligence. There's no human intervention. It picks up commentary on India, rates that commentary on the basis of the algorithm that is being fed.
3,000 MNCs?
Yes, okay. Every quarter. And then we produce an index which we call as the sentiment index. Where is that? Here. Okay. Where is that relative to China? Where? So India is not only performing well on an absolute basis, but this is the best India has been even relative to China. We often get into this debate versus China.
Yes.
So this is our moment. It has arrived, and therefore the market is buying all these dips. It's not giving you easy money.
With Ridham Desai, we've always focused on today, tomorrow, this week, next week, sectors, themes and valuations. But let's talk about the big decadal trend. COVID, unfortunate, but it has rebooted a lot of things. Our prowess in digital, our strength in vaccine distribution, our openness to really, accept foreign capital. Are these changes which in a sense are reminiscent of reforms or countries which saw 10-year bull run, like 80s it belonged to Japan, then came China? Could the next 5, 7, 10 years even more belong to India? Is that the theme? Is that the spirit we should focus on?
So I'll tell you, in COVID, the big delta that has come is the comfort that CEOs have with work from home. Okay. Now work from home and work from India is the same thing. So when you are a New York-based firm and your employee is sitting in New Jersey or in Florida, it doesn't really matter if that same employee is sitting in Mumbai.
Yeah.
Okay. Mumbai has 24/7 internet and electricity, and therefore is as good as Florida at 1/10 the cost. So what has happened in the last 2 years is that our share of global services exports has gone from 3.7 to 4.3. So huge jump.
Yes.
So it's near 20% increase in market share, and this is, I think, going to continue. So a lot of multinational firms will come to India to employ our people to outsource services. And that I think is the most enduring trend I'm picking up from COVID. Some of the other things may come and go, but this trend will, I think, persist. Like for example, we are seeing a reversal in consumer behavior with respect to say e-commerce, with respect to OTT, and people now want to come back to the theaters, they want to go back to the shopping malls. So some of those may prove to be less enduring, less permanent. Of course, e-commerce and OTTs will also have their thing, but not like what we saw in COVID. The one thing which I don't think is going back to pre-COVID or anywhere close to that is offshoring. I think offshoring, India is set to remarkably grow in the next 10 years. And that has implications on our IT services firms, which I must acknowledge compared to my view, say 10 years ago, have delivered exceedingly well
Yes.
on the digital transformation. Remember, our IT services firms in the first decade of this millennium were largely enterprise services
shops.
firms. Yeah. They transitioned very well to digital, and now they are equipped to actually deliver digital solutions. So even if the US slips into recession, they may not undergo the type of slowdown that they have in the previous US recessions. So that I think is the enduring trend from COVID, and that certainly helps India's macro. The other thing is, supply chains. A lot of supply chains got dismantled. I remember when our Prime Minister was on television talking about Atmanirbhar Bharat, a few of the economist community said, "Oh, not again. We're not going inwards."
Exactly.
I think he was very misunderstood there, because what he meant was self-reliance, not closing the economy. And self-reliance is, I think, a very strong theme. It will play out in defense. So
It
we
is
are
evident.
the world's largest importer of defense equipment. We are the third largest spenders on defense in the world. And we're clearly going, in-sourcing rather than outsourcing. So our defense businesses will grow in the next 10 years. So a lot of these themes have emerged in the last 2 years. COVID is one catalyst, but then there are other things that have happened along the way.
It has just accelerated the change, let me
Yes.
put it this way. Let's look at the design of the world. China is slowing down by choice. Europe is slowing down because of war and energy shock. The world is globalized. On a relative basis and on an absolute basis, how much shock can India withstand? Because if two large engines are slowing down, you will have to slow down.
So Nikunj, in fact, I would put the US into play because that's the most critical economy, it being the largest in the world. If you look at the last 30 years, ever since we opened our economy to foreign investors, sometime in 91, 92, so it's nearly 3 decades, right? India, the stock market, has gone into a bear phase with every US recession.
Yes, yes.
Okay, so a US recession means a bear market. Some of them are terrible bear markets, but we get bear markets. Okay, I dare say that if the US slips into recession next year or later this year, we may not get a bear market this time in India, and that's the transition that has happened.
Why do you
now?
say
How
that?
did it happen?
Yes.
Okay, so it happened on account of two, or I should say 3 major policy changes that have been enacted in the last 5-6 years. And this is not relating to COVID. This is all in place pre-COVID, okay? COVID only delayed its implications. So the first change came in 2015. In fact, first couple of changes. The government transitioned, or rather mandated the RBI to target inflation.
Yes.
Until then, the RBI did not have an official target. It targeted whatever the government of the day asked it to. So sometimes it was growth, sometimes it was inflation. But we mandated it by law that the RBI will target inflation and the parliament will decide what level of inflation we can tolerate as a country. And that was determined to be 4%, which is still 4% with a range of plus minus 2. So we became an inflation targeting monetary authority. The second change that happened was, and that slipped under the radar, and a lot of people actually did not pay much attention to it because they didn't believe in it, was that the Prime Minister, through policy, allowed the retirement funds in India, National Pension Scheme and Provident Funds, to invest in equities for the first time.
PPF can invest in India.
Yeah. So this was reminiscent of 1980, when President Reagan allowed 401k plans to invest in equities. What you got then was a 20-year bull run in America led by domestic flows. And 2015 set the stage for a similar 20-year bull run in India led by domestic flows. Now you're seeing that unfold because along the way we had a few hiccups. Systematic investing and investing from retirement funds is here to stay. And a lot of people give us pushback that this will change, let the market go into a bear market. And my response is, yeah, there could be temporary outflows, but the secular trend remains. Now what that has done is, it has actually allowed the RBI to run a more independent policy, monetary policy, because we are a lot less reliant on portfolio flows. Simultaneously the government went on this path of encouraging FDI through various policy measures, and that has increased the share of FDI in BOP. So again, together, this is allowing the RBI for the first time in history to stay behind the Fed. I mean, if the RBI had attempted this any time in the past 20 years, the rupee would have got smacked. Not anymore. We can comfortably do our own thing, which is run a relatively independent monetary policy. And the third thing was the shift towards corporate profits. So this shift happened in September 19. The government surprised us by cutting corporate taxes quite significantly, and it set the stage on improving corporate profits to GDP. Now the thinking behind this was that if profits rise, companies will invest. When they invest, they'll create jobs, wages will go up, and there'll be all-round prosperity.
The flywheel effect will start.
Yeah. Now this effect got delayed by COVID, yes, but it is now coming through. So corporate profits are improving. In fact, in 2019, they were at 2% of GDP. Now we're already at 3.5%. And if you look at quarterly earnings of corporate India, starting from 2019 to date, except for the quarter ended March 20, there is no COVID in earnings.
Yes.
If you look at the earnings, where's the COVID
Where is
effect?
COVID?
There's no COVID. Why? Because there is a continuous policy thrust on keeping corporate profits, elevated so that they can start a private investment cycle. And that's what India is going to go through in the next 10 years. It's going to be a very big theme. We will see a huge amount of capex in energy, in consumption-related sectors, in infrastructure, in many sectors like we have never seen before. And that will lead to greater prosperity. So this is the new India that is now therefore more insulated from a European, I would say, demographic stroke energy shock slowdown, from a China on a COVID policy shock slowdown, and in the US where maybe they have erred on policy and therefore they are actually facing problems. We are actually looking very different from the rest of the world.
Okay. You've set the tone beautifully for us that indeed this time the positioning of the economy is different. But ultimately price is what you pay, value is what you get. The fact that we've not corrected this year at all, the fact that index now for the year is almost flat, some would argue and say that the wonderful picture or the template Ridham Desai has just painted, I agree with that, but I think markets are pricing that in.
Yeah, well, see, that is something that we were discussing end of last year, that the markets do look a little frothy, especially in the mid and small cap area. And I think we've gone through a price and time correction. And net, I think we could continue to see time and price correction in select areas. So it's not like a bear market where everything falls irrationally or falls together. This is what I would call as a bull market correction, which will pick its areas to correct, and the market is going through a time correction. It doesn't need to. If it's a price correction, it gets quickly picked up because underlying the market knows that we are in a long-term earnings story, and the time correction is actually panning out. I don't think passive investors have actually made money in the last 12 months.
Do you think the most over anticipated importance we give to is FI flows? We are fixated with FI flows. FIs are selling, okay, bad news for the market. And on the other hand, we have perhaps not realized the potential of domestic flows. That's the story this year. I mean, there are a range of estimates depending on what data you're looking at, but the FI selling this last 18 months stands at $15 billion and just got absorbed.
So Nikunj, I've been writing about this for years now, that this flow business is a very is a lose-lose game. Okay, which is I have not figured out how to forecast flows.
Nobody knows.
Right? So it's impossible to forecast flows in the short horizon. And flows actually lag price. They don't lead price. So they follow the price. The price actually makes the first move, then the flows follow. The third point is why fix your attention on one segment of the market. So on a big picture basis, there are three owners in this market, right? There are the domestic owners, which is retail plus mutual funds plus insurance. There is the foreign shareholder, which is the foreign portfolio investor, and then there is the controlling stakeholder, or what we call as promoter. Now the promoter is not selling and buying on a daily basis, so there are only two entities. If one is a persistent buyer, the other has to be a seller, otherwise how do you get a trade? And this is the simplest explanation as to why foreigners are selling. So if you look at the last 2-3 weeks, foreigners have turned buyers. Guess what? Domestics are selling, right? Because otherwise you cannot get a trade, right? So it is very, very rare, okay? And in fact, I have done the math on, I have separated the domestic basket into two parts, which is retail, direct participation, and institution, right? Because we do see sometimes domestic institutions and foreign institutions buy, but that's because retail is selling. It is impossible for all three to be buying at the same time. Yes. So the minute you say, oh, when are foreigners going to buy? I say, yeah, when domestics are selling. Are you going to like that? Because so it's not about who's buying and selling, it's about who's setting the price at the margin. The domestics are the marginal price setters, and I don't think that's going away in a hurry. They will continue to be the marginal price setters. And the foreigners were very important for the macro, but as I explained earlier, in the equity markets, they are no longer as important, which is why, forget about the stock market having absorbed $30 billion of selling. The macro also absorbed it, yes, without a problem. We couldn't in 2008. In 2008, oil went to $150 in the middle of 2008. India was relatively unaffected by the global financial crisis. Our banks were not in trouble, but oil went up. And because oil went up, foreign equity portfolio flows sold because India's macro hurts. And the consequent effect was that the Sensex, or the MSCI India index in dollar terms, was the second worst performing market in the world.
50% drop in 1 year. I distinctly remember the scary days in this office itself.
Exactly. And we had nothing to do with the global crisis. Our earnings were still going up. Okay, and the markets were falling. Why? Because we were so dependent on foreign portfolio flows, which in turn were so sensitive to India's macro correlation with oil. This year, we had another oil shock, and everybody's view was India will get slammed, stocks will get slammed because oil is going up because of a supply shock. Nothing happened because we are no longer dependent on foreign portfolio investors to fund our current account. Our current account is being funded by FDI, and FDI is not as sensitive to oil. Yes. Which is why I also think that our behavior to the next US recession will be different from the past, because it will not be accompanied with outflows, and even if it is accompanied by outflows, those are going to be in the equity markets, not in the direct capital flows, and therefore we will be relatively less affected. So this transition in our macro has happened over the last 5-7 years as a consequence of policy, which is why my last report was how policy works. Yes. And the reason I wrote that is because in one of my recent engagements, somebody criticized me for focusing too much on policy, that it's not about policy. And the fact is that market cycles are created by policy. Yes. If you're a long-term investor, it doesn't matter. You buy a good business at a good price, and in 10-20 years you will make money. But if you want to time market cycles, policy plays a very big role, and we are at the positive end of the policy action on a global basis.
Okay, so I'll stay with the global theme, and I'm purely focusing on the price action. Markets are nearing an all-time high, not far away from an all-time high. But if I look at the performance of global dominated sectors, metals, IT, there are genuine concerns. While you've explained to us that, look, this time IT cycle is different, metal is a global commodity, but would you also consider price action as an indicator? Maybe we are overestimating what is happening in IT. Maybe we are not resilient, we are not compiling that the impact US recession could play out.
See, Nikunj, it's all about time frame. Okay. So, when I invest as an individual investor, away from my job as advising to institutional investors, I have a very long time frame. So for me, it's only about price, okay? Because everything else will sort itself out in time. So the only thing I wait for is a price. And when the price comes to me, I'm a buyer. At all other times, I just wait and watch. Okay. Now, institutional investors cannot function that way
They have
because
compulsions,
they have
benchmarks
to do
beat.
weekly, monthly, quarterly returns. Okay. So they have to be in this market cycle business. As an individual investor, and for those individual investors watching this program, they don't have to be in this market cycle business. It's a very tough business to be in. The smartest investors out there struggle with it. Okay. The best thing is focus on the price. You have identified a good business with good people, well run, reasonable moat. When the price comes your way, just buy it. The price will only come your way when things are bad.
When the good news and good price, they say, never comes together.
Exactly, when things are bad. And when things are bad, and this is what I said at a recent forum, the only thing you need for successful investing is not good intelligence.
Courage.
You only need a stomach. It's here, it's in the gut.
Yes.
It's where Ayurveda lies. Ayurveda is totally focused on the gut. It's the health of the gut that determines the health of the body, not the health of the brain or the heart.
It's the other way around.
It's the health of the gut. And likewise in the market, it's your gut that will determine your success, not your head. It doesn't require too much IQ to win in the markets. It requires a lot of guts.
Time and patience are also important.
That comes from a strong gut.
Exactly.
So if you are able to sit through a downturn and not do anything wrong, not do anything in a panic, you'll be okay.
But the Ridham Desai I have interacted with earlier was into heavy weights and instant gratification. Now it's about yoga and gut health. That's a different Ridham Desai from last decade.
Nikunj, it's unfortunate that when we are young, I shouldn't speak on everybody's behalf, but let me speak on my behalf. When I was young, I didn't listen to the elders around me. Okay, and it took me 30 years to learn all that they already knew 30 years ago. So when I look back, I say how I wish I'd listened to them 30 years ago. I would have never deviated from this path. All that we want to know about life, all that we want to know about the body, all that we want to know about anything is already contained, okay, in the millions of words and thousands of pages of so-called scriptures that have been written, okay, by people who are deep inside from the inside.
So it's no longer bench press for Ridham Desai, it is Surya Namaskar and Pranayam. Okay, so since we're
evolution,
about,
we call it evolution.
So since we're talking about experience, well, you got a lot of experience in understanding market cycle. One interesting feature of the report which I have in my hand is you're making a case that bull markets or markets, they never repeat itself, but history does rhyme. And if the current trends are anything to go by, this bull market is alive, kicking, and has a long way to go. I could have added another long.
See, there are a few things that we will keep aside right now as potential risk factors in the medium to long term. We do have to worry about global geopolitics. It's not as smooth out there as we would want it to be. It never was smooth, but we are getting bigger as an economy, as a country, and therefore we are far more linked to these things than we have ever been. We're the 5th or 6th largest economy in the world. We're the 5th largest, 6th largest stock market in the world. So we're no longer a small cap name. Okay, we're a large cap player here, and therefore global events will affect us. The US economic cycle, global demographics, these are factors that are weighing on us. China was in a way a little lucky because China's boom came at a time when the global demographics and global growth was heading to its peak. Now it's heading into a multi-year decline. We have to fight that decline and still assert ourselves. We have our own political cycles, yes, and we are a democracy. I cannot tell what the people of this country will do, and that also is something that we have to keep in mind. So keeping these imponderables aside, on which I have no view whatsoever, I think that's a very fair assessment you make. I again dare say this will exceed the 03-08 bull market when it's done and dusted. So we are still...
Then your Sensex target of 62,000 for next 1 year is very conservative.
See, that's the context of what my global strategists are saying, and they are pretty bearish on the global equity markets. So they have all got absolute declines in their markets. I still have an absolute increase, so we will outperform. A 1 year target is really not of consequence when we talk about a 10-year view. but that target has got that context. And if they are right, and if the SPX declines another 15-20% from here, it's very hard for the Nifty to go up. But I still think it may actually do okay.
Why are your earning estimates pricing in almost a double in terms of earnings growth? It's 13% for FY23 and they go on to 26.5 for FY24, which means that you expect that irrespective of what is happening on inflation, war or energy shock, FY24 is going to be a linear year of bumper growth.
So I think, Nikunj, a lot of those things have been absorbed this year.
Okay.
And that's why growth is moderating. And we'll see how it turns out. This quarter started off extremely well and then tailed off in the end. I think we're tracking about 13% growth, broad market. Okay.
Which is not bad.
Yeah, well, but expectations were 20%. Okay. So consensus will have to cut estimates. So my number was already behind the consensus because I thought these near-term pressures, and this may continue for another quarter or so, though it may have got priced into the market at the June low. Now the market is no longer pricing it in, but at the June low, the market had already absorbed the potential slowdown in earnings. So I think this is a kind of a year of consolidation. We've had 2 very good years of earnings, year of consolidation, and then we continue on that journey. Because I still think we have a few years to go of earnings growth. That 2% has gone to 3.5%, corporate share, corporate profit share in GDP. The previous peak was 7%, and it's quite possible we surpass that. You do the math. Even if nominal GDP growth is 10%, nothing aggressive, but 3.5 goes to 7 in 3-4 years, profits will compound at 20.
For profits to compound to 20, where do you think the entire, what would be the linchpin in terms of sector? Will it be led by good old financials again, because that's the best proxy and the easiest proxy to bet on?
See, it's a trick question. I ask a lot of seasoned market participants and nobody has answered this question correctly. So the question
You're doing my job. It's my job to ask questions.
I'm asking you a question. So what do you think is corporate debt to GDP now?
Look, I don't track it the way you track it, so I have an option of saying pass.
So you pass. So the typical answer is 60%. Well, it's actually 46. Okay, it's at a multi-year low. Corporate India has gone through a phenomenal deleveraging in the last 4-5 years. Okay, we're sitting at the throes of a major loan boom. Loan boom requires 2 things. Okay, a lot of people think low interest rates, but no, low interest rates is not what requires a loan boom. A loan boom requires optimistic growth and space on the balance sheet. We have both.
Yes.
We have an optimistic growth outlook, and the balance sheet is very light. Banks' balance sheet light, corporate balance sheets are light. So it is set up for a loan.
Even
boom.
retail balance sheets.
Yeah.
I mean, the NPA.
Well, retail is not as light as it was, say 5-7 years ago, but it is overall very light, 18%. That's household debt to GDP. Okay, combined corporate and household debt is 64% of GDP. The whole world, large countries all sit in big 3-digit numbers. Okay, so we have a long way to go. This is going to unfold, and on top of this, we have this unique digital experience experiment going on in the country. Okay, people underestimate how Aadhaar has actually
worked. Jam Trinity, as we call it.
Yeah, well, now it's no longer Jam Trinity because on the eKYC, on top of the e-sign, on the digital locker, on UPI, we have built now the health stack, we've built the e-commerce stack, we've built the account aggregator stack. These are phenomenal innovations. The account aggregator stack has the potential to create a loan boom of the type that we cannot even imagine today. So yeah, you said good old financials, but actually I will say good new financials. They're about to deliver strong growth that they have not done. People do not realize that the last decade was a virtual write-off of financials. Only a few select banks could deliver growth. Most of the banks actually had no growth or negative growth.
But that was for corporate banks. Retail banks did rather well.
Well, you distinguish between retail and corporate. Everybody does everything, and except for 2 or 3 banks, everyone struggled. Now you'll see broad-based, I think, performance from the banking sector. So I think there's a loan boom coming. Okay. The other area is capex, as I said. So I think industrials will do very well. And that is a space which people should watch out for. a lot of small industrial companies that deliver capital goods solutions, that actually deliver capex, that are engaged in construction activity, that are engaged in building factories, I think are going to do very well. I would add real estate to that as well, because I think real estate is technically financials, but it will participate in this. The underlying theme here, Nikunj, is pent-up demand. You see, in a lot of sectors, we have had no demand in the last 10 years. Cars, we are selling the same amount of cars as we sold in 2012. 10 years gone. Okay, this market has not grown.
And affordability has increased.
Housing, okay, we have not seen major housing sales in the last, exclude the last 4 quarters. Prior to that, there was nothing. There's so much of pent-up demand. So that's the second theme. So a lot of pent-up demand. So residential housing, autos, auto parts, okay. And the third is the transformation that's happening in the economy. So let me explain this to you. So
Yes.
bear with me for
No,
a couple of minutes. We're a $3.5 trillion economy.
Yes.
$2,200 per capita income. Typically, half of that income is spent on basic stuff. Okay.
Food to be a large part.
So food is
Food and
large part. Shelter, basic shelter and clothing. Kapda, roti, makan.
Yes.
This is 50% of our consumption
Maybe more
basket.
actually if I add up inflation now.
No, well, I'm saying on a real basis. Okay. It doesn't include people like you and me. You and me don't make up the economy. Of the remaining 50, about half of it is saved. Okay. Actually, about 40% is saved, and the rest of it, which is about $500-600, is available to do other things. Other things include what? Sending my kids to school, taking a bus to work, going on a vacation, painting my house, buying a television, buying an air conditioner, buying a jahan pe jo hai, okay?
In your
Now,
case, it was gym.
3.5 trillion goes to 4 trillion. Okay, so that is a 15% growth. Now, on the face of it, it doesn't look like a big growth. But what happens is that the per capita income goes up by $300. Okay, now roti kapda makan is going to be the same.
Yes.
You can't spend more on that. You're saving about 20%. The remaining $250 adds on to the $500. What's that? That's a 50% growth.
The base
तो
is
जीडीपी
50%.
15% जाता है, लेकिन जो डिस्क्रिशनरी कंजम्पशन बास्केट है वो 50% ग्रो होता है.
This is the binge spending which we are talking about.
So
which
this is
coming
the
back in
third
economy.
theme. Now what is this being spent on? Depending on where you are in the pyramid, you may be sending your kids to school because now you're able to, because roti kapda makan ho gaya, or you are upgrading your home,
Insurance.
or yeah, you're buying insurance, medical and life, or you are doing travel and leisure, or you're going to the theater to watch a movie. All these in India are discretionary spends. Everything other than roti kapda makan is discretionary. Okay, depending on where you are, with the exception of mobile phone, because mobile phone has ceased to be a discretionary spend. So if 15% is the nominal growth in the economy and 50% is the growth in discretionary consumption, the third sector, which I think ends up doing very well, is discretionary spending. So you can make your picks there. There you have to be careful about valuations, because some stocks, unlike in the banks where stocks are still relatively.
Then why not staples? I can upgrade my brand. I can
ये देखो आपका distinction है staples discretionary. I see it as consumption.
Okay.
Okay, you make your choice there, because you have to pick up the business that has got. So soaps will not do this, because soaps in large part is staples. Okay. So that's not the one that will benefit from this 50% rise, right? So something else will. So you pick up those. Now whether you categorize them as staples or discretionary is really not at all consequential.
Where does innovation come in? We will innovate. We have innovated. Every bull market in a sense has its own set of innovators, and we have innovated on every front. You started speaking about manufacturing. There is, we know that innovation is happening in the fintech world or the technology world. How much weightage would you give to innovative India in this decade?
Innovation is an ongoing process. I think we have certainly leaped a generation on tech because of Aadhaar. We have leaped a generation. I actually compare the India stack to Web3. And again, a lot of people think that's a very loose comment. Yeah, maybe it's not a very accurate description of India stack, but it has got characteristics of Web3. And remember, Web3 is the biggest tech revolution that's happening in the Western Hemisphere. We're already at the forefront. Now, in India's history, that's never happened. that we are already there where the Western Hemisphere is trying to be. We've always been many, many years behind, in some cases decades behind the Western world because we've been poor. But on technology, I think we have really leapfrogged. So this is largely a disruptive force. And therefore, when you're making your investments, you have to be careful that you're not getting disrupted by technology. It could be happening. I mean, like you gave the example of fintech. Though I think fintech is also going to be kind of ring fenced by regulations because it's in the RBI domain, so regulations will always come in. So it will not be a explosive growth there because RBI will always be concerned about macro stability. But in other areas, like what ONDC is going to do to how products are sold in India and how they get branded and how they get delivered is going to be quite revolutionary. So you'll have to incorporate that into your views on any business that you are looking at, that it's not getting disrupted, that it's actually benefiting from these technology changes.
Couple of last follow-up questions. So if I say that the right to win in financials is still with large banks, will that be a fair assessment?
See, right to win in financials is the one who has deposits.
That is with large banks.
Well, it depends. It depends. Okay, there could be small banks that could do deposits as well.
You can lend if you have money.
Deposits is relative to your balance sheet size. Okay.
Yes.
So you may have a large deposit base, but if your balance sheet is also large, that may prohibit you from growing, right? So deposit is in the context of your balance sheet size. So it's not material whether you're large or small. You need deposit franchise. That's your main thing. The second thing is you need good risk management. Because what happens is that, of course, in the early stages of the cycle, mistakes are not made. But as the cycle matures, then the mistakes start building up, and then NPLs start accumulating, and then that comes to play as the cycle ends. So having good risk management and having a good deposit franchise is the secret to winning banks.
I've always enjoyed reading your reports, and time and again you've referred to market style. That market is also about cycles and mean reversion. Let me put in the most important ingredient which decides the valuation of the terminal value. I'm just breaking it for our viewers. Interest rates play a role in terms of how you value a company. Interest rates will move higher. At the beginning of the year or late last year, it was all about growth companies. Then value has made a comeback. Now that things are normalizing, what would be the dominant style of this market?
See, the consistently winning style is always buying growth at a reasonable price.
That's in India.
Everywhere in the world.
Everywhere. Okay.
The only problem is that you have to forecast growth. Price you see. Therefore, it's very hard at any point to tell how much of that growth is priced in. It's very hard. Even so, the normal tool that people use is PE, but PE is very misleading. 60 PE is not necessarily more expensive than 6 PE because it all depends on the growth that business gives. Okay, so it's always about growth. Equities is all about growth. Everything else doesn't matter. Even interest rates, the point that you made. So this is the argument I make to a lot of people. That
it is believed that interest rates go higher, growth stocks come down.
No, that is not true. Between 2003 and 2008, interest rates went up a lot.
Yes.
Okay, in the US they went from 1% to 5.5%. In India, when they from 6 to 9.5% before they peaked. Okay, but the best performing stocks were growth stocks, and growth did extremely well. That period, Nifty earnings compounded at nearly 30%. Okay,
yes,
and interest rates were continuously going up. So rising interest rates is not an impediment to growth. Rising interest rates are actually good if they signify that growth is improving.
Yes.
When it is being raised only to combat inflation in a low growth environment, that's when it creates a problem because growth is low. So it's always down to growth. The denominator, which is in equities, the best way to and the only way to value is to discount future cash flows at your expected rate of return. But Nikunj, your expected rate of return is not hinged to the RBI. Okay, when the RBI was running sub 4%, did you lower your expectations from equity returns? No. If you thought that you needed 12 to 14% returns from equities to invest, it was still 12 and 14. Now, since then, we have had a few rate hikes. You're not moving that number up. It's still 12 to 14.
It's always been 12 to 14 in India.
Exactly. So your expected return, which is the denominator in the discounting model, does not really change with interest rates unless there is a big move. So then that is a very different situation and doesn't happen overnight.
So two more follow-up questions. at the beginning of the decade, if I just examine the Nifty, the weightage of the Nifty, almost 35% is directly and indirectly financials, including NBFCs and insurance. The second comes in IT, auto is less, metals are less. 5 years from now, because Nifty keeps on evolving, the compositions, they keep on changing. What kind of Nifty composition do you see?
I think consumer will be higher than where it is today.
That includes staples and discretionary both.
Yeah, I think overall consumption will be higher. I think there will be a lot of new companies that will come in, which we can call as technology companies, but they're not necessarily technology companies. They just use technology to deliver their product and services to their customers. So even the existing so-called internet companies happen to actually belong to different sectors. They are not internet companies. You know, one of them is maybe a service company, the other one, you know, is in the insurance business like that, or somebody else is in financial services. So
Some of them would be part of the index.
So I think these technology-enabled companies will occupy some space in the index. I think financials may not be able to increase weight. Okay, so they may go through a cycle and then come back, because you're asking for a 5-7 year view. That's why I'm saying that. We'll see a similar thing with industrials, which will go back and come back. But you know, this is a very hard thing. So basically, the question is what will outperform.
Yes.
I think at the end of 7 years, consumption will be the king.
In 2018, at the Morgan Stanley conference, we had a very interesting point on mega trends. And you said, look, for me, what matters when I identify a mega trend is the need and the relevance. It's 2022. I haven't spoken to you on mega trends because of COVID. What are the mega trends? And just to give a hint to our viewers, that time Ridham was in minority when he started speaking about pollution and need for EVs. Today it is a fashionable word. Ridham always.
So mega trend, of course, I think energy transition remains.
That's EVs.
So we will transition in energy in a very big way. Okay, so this is just the beginning. So that doesn't change, even though 5 years have passed. We're still in the early stages. I think indigenization of defense will be a mega trend. I think we will reduce our imports significantly on defense, and we will manufacture more and more at home. The evolution of the consumption basket, it will become more and more sophisticated. So that will be a mega trend. So therefore auto parts, autos, a lot of these sectors will actually participate in quite a big way in India's growth story. As I said at the outset, manufacturing will gain share. So that will come actually at the expense of services. So even though services will do well, manufacturing will actually gain a bit of share because I think India will receive significant investments in manufacturing, and India will become in part a global supply chain participant, which it hasn't been ever. So we will start being a much bigger player in global supply chains.
You know, this is the first time I'm interacting you after COVID, so it's so nice to meet you in person. There are some habits which have changed permanently, there are some habits which will not change. So I'm glad our interaction has come back and we are meeting in person, so let's do a high-five and then we'll go to the high-five.
Okay.
This is something which you always get a pleasure when you meet old friends in person, so that's it on this very special interaction with Ridham Desai. Hope you enjoyed the show. Thank you, Ridham, for joining us, and thank you viewers for watching it.